Good morning and welcome back to the session International Banking and Finance. In this lecture, we will study components of balance of payment. In this lecture, we are going to learn current account, capital account, reserve account and difference between current account and capital account. This is the chart showing main components of balance of payment. Balance of payment is divided into three main parts. First, current account, second, capital account, and third, reserve account. Current account. The current account of balance of payment is made up of three main balances, namely merchandise, services, and unilateral transfer. Current account effectively reflect net flow of goods and services and unilateral transfers, namely gift, donation, legacies, etc. Balance on current account can be thus defined as net value of the balances of visible trade, invisible trade. Visible and invisible means goods and services and unilateral transfer. Balance of payment on current account thus covers all the receipts and payments arising out of trade and personal remittance. There is no reverse flow in current account transactions. It means if you export or import, if you export, you will receive the money, and if you import goods, you have to make payment. There is no reverse flow in future. This means that the current account represent all self-liquidating transactions which constitute ready or immediate demand for and supply of currencies for an economy over a given period of time. Thus, it has a direct impact on exchange rate of domestic currency. Capital account. Capital account records all international transactions that involves creation of assets and liabilities in foreign currencies. These transactions involve reverse flow. For example, a loan taken in a foreign currency creates ready inflow with corresponding future liability payable. On maturity of loan, the outflow would take place. The capital account thus record all receivables and payables which would impact the demand and supply equilibrium in future. Classification of transactions as either current or capital therefore does not depend on nature of the asset but on nature of the transaction. The transactions under capital account are classified as foreign investment, loan, banking capital, rupee debt services and other debt capital. We have learned about current account and capital account. Now we will see the difference between current account and capital account. The classification of transactions of either current or capital does not depend on the nature of asset but on nature of transactions. In current account, only those transactions are recorded which do not create any assets or liabilities. Whereas in capital accounts, transactions are recorded which creates assets and liabilities. The nature of transactions of current account are self-liquidating, whereas transactions recorded in capital account are not self-liquidating. In current account, transactions do not create reverse flow, whereas in capital account, transactions create reverse flow. Transactions in current account creates impact on demand and supply of currency, whereas transactions in capital account create impact on equilibrium of demand and supply of currency. The impact of transactions recorded in current account is immediate, whereas impact of transactions recorded in capital account is in future. The last one is reserve account. This account includes the reserve assets, that is, the asset that monetary authority of the country uses to settle deficit that arises on the other two categories taken together. These other two categories, it means current account and capital account. Official reserve assets are those financial assets that can be used as an international means of payment. Reserves are held in three forms: in foreign currency, usually but always US dollar, second as a gold, and third as a special drawing rights, that is borrowed from IMF. Note that reserves do not have to be held within a country. Most of the countries hold a proportion of their reserves in account with foreign central bank. The changes in countries' reserve must of course reflect net value of other recorded items in balance of payment. These changes will be of course recorded accurately, and it is the discrepancy between the changes in reserves and the net value of other recorded items that allow us to identify errors and omissions. In next lecture, we will study more detail about balance of payment. So, we will meet tomorrow. Thank you.